Why is calculating lot size so important for being a profitable trader? Calculating the correct lot size will make or break your risk management. Most traders have no clue how to calculate this. With the correct lot size and the use of leverage, you can become profitable very quickly. In this video, I'm going to walk you through how to use lot sizes and leverage to make the most amount of profit. To do this, first, I'll help you understand what pips and ticks are. With this foundation, I will show you how to calculate your lot sizes. And after that, I will share how to use leverage to make the most amount of profits with the correct lot size. So let's get into it.
Let's start with a small recap. By now, you should know how to read candlesticks and their respective patterns. You should know what time frames are with the Rule of 3 framework. You should know what to trade on the Forex market and indices. You know by now how TradingView works. You know what market structure is and how to use it. And you know what futures are and how you trade them with the indices. In this video, we're going over what leverage is. And specifically, we're going to talk about pips, ticks, points, lot sizes, and we're going to do some calculation on this. When I started to trade, when I was ready to execute my first trade, I went into my TradingView app, I went to my MetaTrader app, and I was ready to take a trade, and I didn't know what to do. And there's where the pip, ticks, and points come in, and how you can lot size, because what do you actually buy or sell? That is where this video comes in. First, let's talk about what a pip is. The term pip is commonly used in Forex trading, so with the Forex pairs, and one pip is indicative of the smallest price move of an exchange rate can make. So if we want to go long, we want to collect pips. You want to take as many pips as possible, because the more pips you can grab or surf with or surf the wave with in the trading market, the more money you make. It is determined by market conventions and is always right of the decimal point. Typically, currency exchanges used 4 decimal places, so the smallest change will be in the 4th place, or in other words, 1% of 1%. And for example, Euro US dollar, current price is 1.08829. In the 4th place after the comma, so 1, 2, 3, 4, this is your pip. So when this goes to 3, it's plus 1 pip. If it goes to 1, it's minus 1 pip. The amount of money that's associated with the change in pips is completely determined by the currency pair in question. So the main rule for Forex pairs is what we just discussed, the 4th place after the comma. So when you go plus 1 pip, it goes from 1.08829, it goes to 1.08839. But for example, USD-JPY, it's a Forex pair, but JPY pairs only have 2 decimals after the comma. So for this exception, for the JPY pairs, the last digit is your pip. So when it goes from 157.35, when it goes to 157.36, you have plus 1 pip. So now you know what a pip is. Let's talk about what a tick is. Where pips are used in Forex trading, ticks are used in futures trading. The tick is indicative of the smallest possible price movement and is right of the decimal. This means that there is not necessarily any standardized amounts across various markets, as the market can choose to set the minimum price movement at any amount that they please. So that means, for example, there is no set rule. So for example, the Nasdaq and the S&P have different ticks than oil futures or gold futures. The movement value of a tick is called tick value. If we look at the tick value in trading, S&P, crude, and gold, they're all different from each other. So the S&P and the Nasdaq, the tick value is 0.25. Oil ticks are 0.01 and gold ticks are 0.1. You don't need to remember everything about this, and I will show you later in this part how you can see this actually in TradingView. Now you know what a pip is with Forex, you know what a tick is with futures. Now we're going to talk about what a point is. And a point is used in multiple ways. First of all, it refers to the left side of a decimal point and is the largest price change of the 3 measurements. So when we talked with ticks and pips about the right side, with points you talk about the left side. A point is usually made out of 1,000 of ticks. Usually the term point is used by traders to describe price change in their markets. Specifically, it is used when describing the changes in price in futures markets and is created by the exchange setting dollar values to correspond with the movements in various instruments. Lots of textbook, guys, you don't need to remember this. Also, you will hear individuals trade stock market use this term to point out to describe how many dollars a stock have moved up or down. So for example, Tesla goes from 249 to 250. It goes plus 1 point. So it's a little jargon. So when you are trading futures and you hear someone talk about, yeah, I made so many pips, you know, hey, this is not an experienced futures traders, because in futures, we use ticks and points. It's not too important for your trading, because you need to, for your actual trading, your execution, you need to just collect ticks pips or points to make money. So let's talk about that right now. Together with pips, we want to collect pips. So we want, for example, you want price to go up 50 pips. If you want to go long, and if you want to go short, you would like to have 50 pips short, or of course more. What you actually buy is lot sizes. You buy contracts, and you have 3 different lot sizes. You have a micro lot that is 0.01. You have a mini lot that is 0.10. And you have a standard lot is 1.00. And in this scenario, we have the euro US dollar from earlier, 1.08829. And let's say it goes up by 1 pip. How much money do we make using 1 micro lot? So you buy 1 micro lot, you buy 1 mini lot, or you buy 1 standard lot. That means with a micro lot, you buy 0.01. What it means is you basically buy 1,000 of that currency when you are buying a micro lot. So what that means is you buy a micro lot, for example, is 1.01. You buy 1,000 of that currency. So if you want to buy 1 micro lot based on the current price, you need to have $1.088 to buy 1 micro lot. That means when price goes up by 1 pip, you will make 10 cents. Same for a mini lot, you buy 0.10. You buy 10,000 of that currency, and you need 10,883 for 1 mini lot. If price goes up by 1 point, you will make $1. Standard lot, again, times 10. 1,000 currency, you need 108,000 for 1 standard lot. And when price goes up by 1 pip, you make $10. Let's go dive a little deeper into the calculation of this. Because when you're going to trade, you're going to have different amounts of leverage. And leverage, we touched upon this earlier in the bootcamp. That means, for example, if you have a 1 to 100 leverage, that means when you have $1 of your own, you get $100 to play with by your broker. If you have $1,000 of your own money, you can have times 100. 100,000 to play with. So for example, when we looked at buying 1 standard lot, we need to have 100,000, over 100,000 to buy 1 standard lot. I know that 95%, maybe more of the traders don't have 100K laying around to put into their trading. And there leverage comes in. Because with leverage, with the 1 to 100, you only need 1,088 times the 100 leverage to get to that 1 standard lot. And that's very nice because now you can play with the standard lot and actually make money. If you, for example, have a 1 to 30 leverage, that means $1 of your own money is $30 to play with, or $1,000 of your money, you have $30,000 to play with. Your opportunities are going to increase because, for example, in the previous example, if we again want to buy 1 standard lot, we need 108,829. But with the 1 to 30 leverage, we don't need that whole 100K. We only need 3,627 to buy 1 standard lot. So the more leverage, the less money you need to buy a lot. Of course, this also has a downside because the more leverage you use, when price goes down, you also lose more money. But in general, with good risk management, what you will learn as a developing trader, it's very nice to have high leverage because you just have more opportunities to make money. To add a little note to this calculation, the quote currency you are using is important for the calculation because in all the previous examples right here, we all use US dollars. So for the USD pairs, so XXX, for example, euro, US dollar. But what if the quote currency is not the US dollar, but the CAD, JPY, or AUD? So XXX CAD or JPY, so a euro CAD or USD JPY, or how do you calculate it then? And then you have uneven numbers and it's quite difficult to calculate. So when your brain is like, oh shit, I want to be a trader, I don't want to be like a math guy, I got you, because as traders, we don't calculate this manually. We have tools for this to do the heavy lifting. And let's talk about that right now. You can start by just Googling lot size calculator. The one I like to use is MyFXBook position size calculator when I am on my computer. And on my phone, I like to use Stinu. It's both for Android and for your iPhone. And Stinu is like, I think, $10. This is free. But when I am trading on my phone, I like to use this very quickly. It's a very nice tool. And let's take a look at MyFXBook to see how this actually looks like. But before we dive into the lot size calculator, we need to know what trade we're going to take. So for example, you are here at TradingView and time recording is Sunday, so the market is closed. But hypothetically, we want to take a trade right here. So we think price will go up and we want to put our stop below these lows. And if I hover my mouse around this, you will see here at the bottom, you'll see stop says 0.0007. And you know, fourth decimal of this pair is a pip. And after you see 7.0, that's the amount of pips. So when you're looking for the amount of pips to trade with, my stop loss now is 7 pips. Let's aim for a 1 to 3. That means, for example, if I want to risk 100 on this trade, when it goes to my take profit up here, I make $300. When you have 7 points risk and a 1 to 3, your take profit needs to have 3 times as time your risk. That means 21 pips. So here as well, it says target is 0.00210. These amount of pips, 21 pips, but it's easier to watch. Just watch it here, 21 pips. So for this trade, 21 pips stop loss, 7 pips risk. And now let's dive into MyFXBook. So now we are at the position size calculator on FXBook, and the currency pair we're trading is euro US dollar. The account currency is US dollar. If you have an account in, for example, a euro or whatever, use your account currency. So for example, my account size is $10,000. My risk, what I want to take with this trade, what I already mentioned, I want to risk $100 on this trade. Well, what is $100? From 10,000 is 1%. If you don't want to calculate the risk, but just with money, you can just say, okay, I want to risk $100. My stop loss was 7 pips. My lot size, my trade size is 1. And then if I have my results with a risk ratio of 1%, amount of units, and my sizing, I need to have 1.43 lots. So that means when I go to my broker right now or to my MetaTrader app, when I actually want to execute my trade, I want to buy 1.43 lots to have this trade. And then I can set my stop loss minus 7 pips. I can set my take profit. I set my take profit 21 pips, and you have a very nice trade. You can even try this out inside TradingView. So the same trade, you hover over it, you press the right click button, then create limit order. Then you have this nice little window where it already says stop loss 7 pips, take profit 21 pips, exact prices. Then you want to say my stop loss is $100 and I want to make $300, and it already says, okay, you need then this amount of units to buy. And this resonates exactly with the lot size calculator from MyFXBook that says like 143, if I remember correctly. You can just buy if you want to trade in your broker, but you just know the exact lot size you need to use. So you can do it both via TradingView. I like to use it via MyFXBook, but that's completely up to you. A final note on a calculation is the risk of leverage. So what we already discussed about when you have a 1 to 100 leverage, that means for your own $1, you get $100 to play with. The same is for when you have $1,000, you can have 100,000 to play with. Leverage is amazing. You can get so much more opportunity compared to when you only have your own money to play with. But this leverage is a double-edged sword. So you need to have really good risk management to use leverage because the opportunities you get to the upside, there's also is danger to the downside. So for example, you have $1,000 yourself and you get $100,000 to play with because of the leverage. That means when price drops 1% from 100,000, what you played with is 1,000. That is your initial money and you cannot lose more than your initial money. But when price drops only 1%, broker would just say your money is now gone and we liquidate your whole position. And then you lost your $1,000 just by a drop of 1%. So know that it's a double-edged sword. Yes, you should use it for the opportunities, but focus on your risk management as well. Thank you for watching this video. In this video, we went over what a pip is, what a tick is, what a point is, how you can calculate it using the lot sizes, and most importantly, how you can use the lot size calculators. Don't go calculate all that stuff yourself. Use the tools like, for example, from MyFXBook or from Stinu. You can also use TradingView for this, and you should be fine with your first trade. If you like this kind of videos, please like and subscribe, share it with all your trading friends, and I'll see you in the next one.